The very low interest rates are like sort of fertilizer, and they over-fertilize the environment and lead to sort of, in a way, weak and fragile ecosystem. I discuss in the chapter on creative destruction a metaphor that's quite commonly used of how the central bankers, when they prevent the process of creative destruction, they're a bit like the US Forest Service that prevents forest fires, and in the end you get build-up of understory and so forth, and until eventually you get more fires and more severe fires as a consequence, and a less healthy forest.
Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager, due diligence, or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we'll have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager Niels Larsen.
For me, the best part of my podcasting journey has been the opportunity to speak to a huge range of extraordinary people from all around the world. In this series, I have invited one of them, namely Kevin Coldiron, to host a series of in-depth conversations to help uncover and explain new ideas to make you a better investor. In the series, Kevin will be speaking to authors of new books and research papers to better understand the global economy and the dynamics that shape it, so that we can all successfully navigate the challenges within it. And with that, please welcome Kevin Coldiron.
All right. Thank you, Niels, and welcome everyone to episode number 6 of the Ideas Lab series. I'd like to start this one by reading a quote. Our earth is degenerate these days. Bribery and corruption are common. Children no longer obey their parents. Every man wants to write a book, and the end of the world is approaching. Could have been taken from the Wall Street Journal editorial pages, but it's not. It's from an Assyrian tablet written 2,800 years ago, and it's one of the many anecdotes that enliven the book that we're going to discuss today. And I like it because it connects us to our past. It reminded me anyway, that the problems we're facing today are at their core not new. They've been faced repeatedly by human societies and solved by human societies as well. So the person who's going to help us think about and frame, I guess, if you will, the modern versions of some of those issues today is our guest, Edward Chancellor. He is a financial historian. He's a journalist. He's also worked as an investment strategist. He's worked in investment banking for Lazard Brothers, as well as investment management as an asset allocation strategist for GMO. Many of you will have read his works that he's published in the FT, the Wall Street Journal, Money Week, among others. And he's currently a columnist for Reuters Breaking Views. In 1999, I believe, if I got that right, he published Devil Take the Hindmost, which is it's on my bookshelf behind me. It's an award-winning book on kind of the history of financial speculation. And we're here today to talk about his latest book, which was just published in both the UK and the US, called The Price of Time, The Real Story of Interest. So, Edward Chancellor, welcome to the Ideas Lab.
Pleased to be with you, Kevin.
So early on in the book, you tell a story about an experiment that happened in Stanford in the 1960s called the marshmallow experiment. And they got a group of kids together and they said, okay, you can have one marshmallow now, or you can defer consumption and get 2 marshmallows in 15 minutes. And about 2/3 of the kids took the marshmallow now, and about 1/3 waited. I'm guessing that you are a 2 marshmallow guy. And the reason I'm guessing that is because it must have taken you an enormous amount of time and patience to put this book together. I mean, just because I'm somewhat of a nerd, I counted up all the endnotes and it was 1,241. Just the amount of work really comes through the pages. So I was hoping maybe you could start off by just telling us about your process. I mean, how long has you worked on the book? How did you manage to do it while holding down full-time jobs along the way?
Well, you mentioned the book I published in 99 called Devil Take the Hindmost, History of Financial Speculation. And that was written sort of at the time of when the dot-com bubble was going on. And I suppose when I was thinking about speculation, I was perhaps quite entranced by the sort of contemporary vogue for behavioral finance and the sort of psychology of investment and investment manias, sort of in the same vein of looking at intellectual vein of looking at speculative manias from a sort of crowd mania perspective, goes back to Charles Mackay in the 1840s. And after I finished the book, I went. I was at a conference in New York in, I think, late 99, 2000, and Dr. Henry Kaufman, formerly of Salomon Brothers, was there.
Dr. Doom, right?
Dr. Doom. And Kaufman started talking about the role of interest in and the Federal Reserve's manipulation of the Fed funds rate in the late stages. If you remember, after the collapse of the long-term capital management in September 1998, and how the Fed cut rates, supplied liquidity to the markets, and then you got the sort of final leg up of the dot-com boom. And I started to think then about the sort of monetary aspects of speculative manias. And then we had the dot-com bust, and the Fed, as you remember, put its foot on the gas pedal once again, took Fed funds rate down to 1%, and we got a sort of global credit boom. And I was then commissioned at the time by a London hedge fund manager called Chris Benoti to write a report on the global credit boom, which came out as a sort of specialist report called Crunch Time for Credit, which we published in 2005. And then I was doing journalism in New York and went to work for GMO in Boston during the global financial crisis. And after the global financial crisis, interest rates went down even lower. And I was working the asset allocation team, and we kept on thinking that interest rates were going to come up again, and they weren't coming up. I initially belonged to that sort of school that thought that inflation was going to come with all the QE, and it didn't come. And I was working with my assistant, who's also your co-author, Jamie Lee, and Jamie and I we did a sort of interest rate project, a long-term interest rate project, because at GMO we kept on getting making poor forecasts for the direction of long-term interest rates. And so Jamie and I made sort of certain headway, I think, on that project. I mean, one of the things we found, which is that interest rates are not mean reverting. If you're an equity guy, and the asset allocation team was sort of mainly equity, we sort of worked with mean reverting models, but we also had completely erroneous mean reverting models for bonds. And I realized our models were, they were worse than a stop clock. They were right at once every 40 years, which is really not good enough. So I began to understand, these long bond cycles, and then we were also, if you remember at the time, just after the global financial crisis, the financial markets came back in 2009 very strongly, not just equity markets, but also capital flows into emerging markets, and also, if you will, carry trading into the domestic financial markets, which is what you, Jamie, and Jamie's dad, Tim Lee, wrote about in your book, The Rise of Carry Trade. And so that was sort of where I was at. And then I came back. We decided to relocate to England, and I left GMO and go back to full-time writing. And I was with a friend of mine who is the chief investment officer of a London investment firm called Ruffer, also asset allocation business, a guy called Henry Maxey. And I said to him, a decade ago, I was sitting with Crispin Odey, and Crispin was saying, it's all about credit. And I said, yeah, it's all about credit. And now it seems to me it's all about interest rates, that through the prism of the interest rate, you can begin to understand, or the extraordinary low interest rates of the last decade. I'm talking, this is 2015 when the conversation took place, that you could sort of have a sort of holistic picture of both what was happening in the financial world, in the broader economy, and to some extent, you could begin to understand where some of the roots of sort of popular discontent were coming from. So and there was one other aspect to it, is you probably know that Jamie and I also did a lot of work on China at the time, and I probably divided, and we became sort of entranced and fixated on the incredible credit boom that was going on in China, the epic real estate boom, and the accompanying investment boom. So the credit boom, the property bubble, and the investment boom were together the sort of the greatest booms I had ever come across in history. And I was thinking of writing a book on China. Actually, in the end, I'm not really a China specialist. I'm not a Sinophile. But you could explain a lot about what was going on in China as an outsider through the perspective, again, of the interest rates and the monetary policy. So it seemed to me that was a project that was worth undertaking. There was another aspect to it, which is back by when I was doing my work on the sort of credit boom, I came to realize, I came to the belief that the central banks, by fixating solely on short-term inflation and allowing that to be the guide to where they set the interest rate, that was creating the conditions in a low inflation environment for these speculative and credit bubbles. So that's the sort of the position I find myself in. And then, from a work perspective, I then found myself reading both the sort of both the history of interest and the history of economic thought about interest, which takes you into some, really in earlier periods, all great economists would think about what interest was, what it did, what it reflected. And it seemed to me that the question of interest was no longer of, let's say, much interest to the contemporary economists, and as it had ceased to be an interest, I don't want to be. I'm a historian by training, not an economist, but I had this feeling that many contemporary economists, academic economists, don't really read enough of the economic, the history of economic thought, and therefore they deprive themselves of the rich insights of earlier writers on interest.
Yeah, and I'm going off script here because I kind of wanted to end our conversation with a question about that, but since you brought it up, I'll ask it now, which is, why do you think that's the case? I mean, what is it about the contemporary policymakers where they don't have that kind of curiosity about history in the same way? And it's funny because, say, someone like Ben Bernanke is an economic historian, and I guess he looked at history and took some lessons, but I don't get the sense that people have that kind of willingness to look back at history and use the experiences of the past to inform decisions? Is it that, do you think people just like, oh, well, this time is different, the world has changed, or is it, hey, we just have to act now and we can think about broader lessons later? Why do you think that is?
Well, look, you teach economics, don't you? And
Yes.
I don't. So you probably have a better idea of the answer to your question than I do. But the way I see it is this: is that the economists are under possibly a misapprehension that their subject is a science, and that once a question has been addressed and, so to speak, solved, you no longer need to think or re-examine that question. And if you consider your subject to be a science, then the history of the development of that science is a sort of is a minor consideration. And so you're constantly sort of lifting up the ladder behind you as you scale higher. So I think, and tell me if I got this wrong, but I understand they sort of downgraded the teaching of both economic history and the history of economic thought in the academic departments. The other thing I think is there is this drive to make everything to make everything comprehensible within an economic model, a mathematical model, and the economic history and the ideas of earlier economists are often not tractable to models. Say, for instance, I realized when I wrote this report on the credit boom back in 2004, I actually leaned quite heavily on Hyman Minsky and a bit on Hayek. And I was in New York shortly after I'd finished the report, and I saw another old sort of distinguished Wall Street economist called Al Vojniloa. Have you ever come across?
I have not, no.
So Al Vojniloa was at Credit Suisse, and he was the Dr. Gloom to Henry Kaufman's Dr. Doom. And in the 70s, they were the most.
It must have been a lot of fun to go out for drinks with those guys.
Vojniloa, he's a charming fellow, and he a very good economist. Anyhow, so I said, well, why does no one pay attention to Minsky? And they said, oh, he's difficult to model. Now, if you remember. And they said the same about Hayek. And then you had the crash, and almost the first thing that happened with the subprime crisis is everyone started sort of, Minsky was the man of the moment. I'm not even sure it's that difficult to model. I mean, I'm not a modeler, but I can sort of imagine how you could make a sort of fairly decent Minsky model. Anyhow, so it's this sort of. It's the desire to make economics, the illusion that you're dealing with a hard science rather than a social science, and the desire to make your understanding tractable through a model that I think makes people tend to sort of forget economic history, but also, which seems to be much more serious, is to ignore the the past economic thinkers. So that's my thought.
Yeah, I really like that kind of visual of pulling up the ladder. Once you've reached a higher spot, and I think about that a lot with the notion of bank runs, right? Because you sort of felt like, well, we'd solved that problem, right? And if you're sitting in 2004 or 5, you say, well, there are no more bank runs. And then, of course, there were. It's just the banking system had shifted from kind of regulated banks to shadow banks. That's where the credit is created. And bank runs are still a problem. In fact, they're a worse problem because we've now created a kind of a market-based credit system that's much more liquid. You kind of, I think, answered partly, but I had another kind of process question for you, which is, the book's called The Price of Time. So that's kind of, gives away how you think of interest. But there's many, and you say that at the beginning of the book, there's many different ways to think about interest. It's a complex subject. There's risk, there's relative balance of power, there's even notions of kind of insurance in there. And I guess my question was, did you start off your work as a kind of a journey of exploration, in the sense, was it like, hey, there's lots of different ways to think about interest, I wonder which one is right? Or was it, hey, interest is the price of time, and I'm going to kind of collect evidence to prove that's the case? How did you approach it? Or neither one of those, maybe?
I think how given that my strongest speciality is in the field of speculative bubbles and manias, that I suppose the area I understood best starting out on the project was the relationship between monetary policy and asset price bubbles, which is a theme that goes through the book, as you know, really starting in detail with John Law and the Mississippi bubble of 1719, 1720, running up to the current day. So I suppose that was my presupposition. And then as I read more broadly on the subject, I became interested in the other facets of interest, or other roles that interest seems to be most important, namely the allocation of capital, there is this, as I mentioned, you go into the 19th century. There are two strands of economic thinkers talking. Both the Austrian school, I think it's Karl Menger and Eugen von Bernbach, the early Austrians, who talk about how interest affects the amount of capital that will be tied up for a period of time. And they talk about sort of that as the interest rate falls, businesses will engage in what they called more roundabout methods of production. And in principle, that would improve productivity, but you can have too much of a good thing. And you could, if you took the interest rate down to a certain level, you would get if you will, a misallocation of capital. But that idea was also arrived at independently by the English economist W.S. Jevons, who said more or less exactly the same thing. So that role of interest in capital, in the allocation of capital, and how the low interest rate can lead to what the Austrians call malinvestment, it became quite an interesting and, to me, quite rich area of research. And one of the things I point out in the book is that a lot of focus in the sort of conventional narratives on the Great Depression on the very high real interest rates of the Great Depression period, when due to the although nominal interest rates were low, the deflation led to high real rates of interest, but it was followed by, if you will, a sort of a cleansing of the industrial processes in the US, and very strong productivity growth in the aftermath. And so people tend to overlook the fact that the US actually returned in what I think roughly a decade and a half back to its trend GDP growth. And I think I mentioned somewhere in the book, and I'm sure you're familiar with the Chicago economist, was he called Victor Karnowitz, who has this idea of the sort of that recessions sort of that the recovery is the inverse of the depth of a recession. That the faster you go down, the quicker you rebound. And what we were finding in the aftermath of the Great Recession is that we went down pretty quickly. Financial markets came back very, very quickly, but the real economy staggered back, and both in the US and in Europe, we had extraordinarily weak productivity growth, and the question then, and this is the argument that people will be burnt at the stake for, is were the low interest rates a reflection of the lackluster productivity growth, or did they in turn contribute? And my thesis is, I think they probably did contribute. But as Hayek says, there are no great experiments in economics, and you're dealing with a petri dish, which 1,000 people have put their thumbs into. So it's very we're always going to have different opinions about these things. But I think it's a very rich vein, the allocation of capital and interest.
Let's talk about that idea, because I had kind of written down that as being really the animating idea behind really the second 2/3 of your book, which is that low interest rates they basically have a causal long-term effect on the economy's performance. And you quote Ben Bernanke, I think, at the beginning of that second third of the book, where you say, in the Bernanke saying, it's important to recognize that what monetary policy affects is not the potential rate of growth, but rather the cyclical part. And really, I think what you're saying is that's not right, that low interest rates, particularly ultra low interest rates, have this kind of feedback effect on the economy and can actually impact, if not the super long-term 50-year growth rates, certainly the growth rates that we kind of care about, 5, 10, 15 years, et cetera. And so I was hoping that we could go through some of the ways that you think that feedback mechanism operates. And perhaps we could start with just the basic one, which is savings, right? So the conventional approach, the conventional idea of low interest rates is, when a recession comes, when the economy slows, people want to save more. And companies who are run by those same people also want to save more. So they do that by investing less. And then you get this kind of potential, reinforcing the economic slowdown, less economic activity. So the idea is, let's lower interest rates, and that will increase spending and increase investment. And you talk about that, maybe that works at in some circumstances, but at ultra low rates, you could actually have people wanting to save more when interest rates are low. Can you explain that
yes,
idea?
I mean this. The relationship between the role of interest in savings is very important, and and I have a chapter, and we elaborate there was this, in the 19th century, one of the early English economists, Nassau Senior, first professor of political economy at Oxford, talked about interest as the reward for abstinence and encouragement. You need it, but it's also, if you think about it, it's not just a reward for abstaining, but it's also a way of compounding your wealth or capital over time. So if I'm going to leave aside for the moment the question of whether a very low interest actually causes you to save more, but if the low interest actually slows the compounding of your wealth, then everything else being equal, you will have less consumption in the future. Now, that would be compounded if the low interest also encourages you to take on more debt. And so I think, when we, the first stage, I think we came to realize that with the subprime crisis, that households, it was not just a US phenomenon. US, I think private sector debt increased by about 50% of GDP in the decade up to 2006-7. And that was British household debt, roughly the same order increase. Spanish and Irish on the periphery of Europe, much greater, and Iceland off the charts. And these were levels of private debt increases were either, in the US case, roughly on par with Japan at the end of its bubble economy period, and in the case of Spain and Ireland, much worse than Japan. Now, you're aware of Richard Koo, the Nomura economist, came out with this thesis called the balance sheet recession. Mm-hmm. The idea that after a boom period, you have your balance sheet is out of order. It's a sort of you could say it's a sort of Minskin Keynesian idea in a way. You've got too much debt relative to your income, and you need to improve your balance sheet in order to get, and that is going to be a drag on demand. So there is one of your ways in which the low rate encourages a lack of savings and a build-up of private sector debt. That when you get to a sort of turning point, then you find that consumption going forward is lower than it would have been otherwise. So that's one area, one pretty clear area in which the build-up of debt and the lack of savings lower forward consumption, and that was also underlined in a book called The House of Debt by two American economists.
Yep.
I think they're called Mian and Sufi.
That's right.
And I think they show in that book that in the counties in the US that had the biggest buildup of debt, that they were also household debt in the period prior to the GFC, they had the biggest dinks to consumption going forward. Now, and this is an area where you see the asset price bubble, in this case, prior to 2006-7 in US real estate, being associated also with dissaving and the accumulation of debt. So in that case, you can see the interest working twofold. One, to encourage the asset price bubble, and two, to encourage households to take on more debt. And in that case, it was, as you know, it was the American households in aggregate taking out $500 billion a year in mortgage equity withdrawal to boost their consumption.
So we've got low interest rates in that explanation, encouraging taking on of debt, which ultimately leads to lower consumption when the bubble bursts and balance sheets need to be repaired. So it's a kind of lowering future consumption. And there's also an argument that it lowers current consumption in the sense that you kind of have this long-term goal in mind of how much money you say you need to retire. And with interest rates at 0 or 1 or something very low, then you kind of need to save more. And that's another argument. Do you?
No. I think that's quite right. But I do mention this. But I think one of the problems with economics is there's the assumption that every nation, every person in the world responds in exactly the same way to the same economic factor. And as I point out in the book, that in the US, there's greater exposure to households have greater exposure to real estate because they tend to be high levels of household ownership, and more exposure to the stock market, whether direct or through pensions. Whereas in Germany, there are more people rent, and actually German households keep more of their assets in cash, and so or bonds. And so I think what we see is that the Germans actually felt the pain of the negative interest rates much more of low and then negative interest rates in the last decade, much more than the Anglo-Saxons, because the Anglo-Saxons said, hey, I'm not getting any money in my bank account, but my house is going up 10% and my equities have gone up 15%. So who cares if I can't, if bond yields are low, and interest rates are low. So I think there was a slightly different response depending on where you were, and again back to the composition of your personal balance sheet.
So kind of a cultural difference in the willingness to tolerate abstinence, I guess. The Anglo-Saxons aren't we feel that abstinence pain a little more maybe than the Germans. I wanted to talk about, just to segue a little bit, and you talked about different responses in depending on the country and the culture, and another way that you talk about, which I think is quite important and not something that I always think about with low interest rates, is this notion of zombification or zombie companies. And you say that if you look at what happened, say, after the Euro debt crisis and the insolvency rates, actually the lowest insolvency rates were in Greece, Italy, Spain, places where one might have expected, higher insolvency rates. And that, you talk about companies being allowed to, because of low interest rates, kind of to continue to limp along. And I wondered if you could just explain that process, but please explain why that matters in terms of the feedback loop of low interest rates begetting continued low interest rates and then continued slow economic growth, because that's really what we're worried about here.
Well, the zombie corporate phenomenon was really, well, it was actually first identified with the savings and loans associations, the thrifts, that got into trouble in the 1980s. But as a sort of widespread phenomenon, it was described in Japan in the 1990s. And if you remember, there was a lot of criticism of the Japanese authorities for allowing the banking system to engage in what was called loan forbearance, of allowing companies that had too much debt, that had too low returns on capital, they were allowed to stay in business. But then, if you think about it, Japan was also the first country to experience, to introduce the zero interest rate policy, ZIRP, and that ultra low and zero interest rates are themselves a policy of loan forbearance. Now you fast forward 15 years, and various international bodies such as the OECD and the Bank for International Settlements start putting out some quite interesting papers on the zombie phenomenon, and they note, as you say, that in countries that had the most severe financial sovereign debt crisis in 2010, 2011, such as Italy and Greece, those were the economies that probably needed a shot in the arm and the reallocation of resources. Instead, once the ECB got round to sort of promising to do whatever it takes, once the markets and the banks and the governments realized that the ECB had their backs, so to speak, there was a policy of loan forbearance. And then the OECD, policy of loan forbearance instituted through the very low interest rates. And then what the OECD and the Bank for International Settlement economists looked at is they said, well, they found that that sectors that were full of zombie companies, that the more efficient companies ended up paying higher interest rates than they would have done otherwise, that there was less job creation, there was less investment, and so forth. Now, and if you're getting less investment, less job, and less new entry, so not only were firms not leaving the industry, but the corollary of that was that there were fewer new entrants. So this goes back to the sort of Schumpeterian creative destruction. So you can see that the sort of I would ascribe it in large measure to the policy, the loan forbearance aspect of zero interest rates. It was actually contributing to the zombie phenomenon, and the zombie phenomenon was in turn contributing to low returns on capital and declining and stagnant productivity. So there you get this low rates begetting low growth, and low growth begetting lower rates, so to speak.
It's interesting. Just listening to that description, you can almost think of these zombie companies as being state-sponsored entities in some ways, and and if you're a new entrant, why do you want to go into compete against the government or a company that the government's has an interest in keeping going? As I was reading the book, it struck me that there's another type of zombie company out there that we don't call zombies. Maybe we should call them White Walkers or something. That they're kind of should be dead, but they can kill you. And that those are companies like Uber and WeWork, which you talk about. Which you think, well, how can Uber be a zombie company because it's growing so fast? But you talk a fair amount about it, and I don't want to mischaracterize what you're saying. You may not think of it as a zombie, but so I'm putting that question forward to you: is companies like Uber that are unprofitable and where there's not a clear path to profitability, yet they're able to grow because of lower interest rates, ultra cheap capital. Do they have that same kind of feedback effect on the economy?
Yeah, I think so. By the way, in the chapter where I talk about the classic zombies, they tend to be industrial firms. I then segue into the misallocation of capital in the tech sector, and argue that yes, that the unicorns. Not every unicorn. Unicorns are these
right.
companies with billion-dollar valuations that have yet to come to the market, and in most cases have yet to turn a profit. And so you go back to what we were saying earlier about the length of time in production. That if capital is sort of in effect free, it doesn't really matter how far in the distant future your profits are going to be. You will encourage the most speculative investments, and a highly speculative investment which never actually meets fruition doesn't actually is a form of misallocation of capital, and that capital could have been used elsewhere. I think in the case, I mentioned, I think Uber probably is quite a good case. I mention Uber in certain detail, and the interesting things about Uber, I probably don't say it in the book, but because cost of borrowing and car leasing was so low, and anyone could go, with too many Uber drivers, and the Uber drivers were earning extraordinarily low return. Their own productivity was extraordinarily low. As for Uber itself, it was blowing billions of dollars on autonomous cars and flying taxis and stuff that was if you hadn't been drinking Kool-Aid in the boardroom, you might have thought that was that these projects were never going to fly. So I don't think that I don't think that it's very difficult to say, but I don't think that a lot of the capital that went into Silicon Valley in this period has actually been sort of productivity enhancing. The too many sort of, if you will, pie in the sky ventures. And that then again links back to the high asset valuations that you get during periods of, the speculative bubbles that accompany ultra low rates. You have to remember that the Silicon Valley businesses, they're not really created to generate useful economic functions at some stage in the future. They're purely financial. I mean, it sounds a bit cynical, but I'm saying this having read the memoirs of people who actually work in Silicon Valley. They're all, as they say, it's all about solving for the capitalization rate. It's all about preparing for the IPO and so forth. They are they're very much, they're sort of casino chips, these businesses, but they can suck in a lot of capital in the process. And again, think of it, everything is sort of related, and that why are people devoting a huge amount of money, pouring it into these tech ventures? Because in a time of very low interest rates, you need to hit the ball, out of the ballpark. So you go for the long shot bet, and because markets have a sort of Ponzi scheme aspect to them, as long as other people were coming in after you had these ramping up of pre-market valuations in Silicon Valley, that was what was a sort of Ponzi scheme, and obviously fun while it lasted.
I'm going a little bit off kind of the script that I had thought about, but as you're talking about that, I was reminded of Bill Janeway had a really interesting book that he published about 10 years ago. And one of the things he talks about is, there may be some long-term benefits to bubbles, because if low interest rates or bubbles generate a lot of investment, and I'm thinking here particularly about, say, the telecoms boom in the late 1990s, early 2000s. The companies go out of business, but we still have the fiber optic cable that they laid underneath the Pacific Ocean, and the society benefits from that infrastructure investment that is facilitated by the ultra cheap capital in the bubble, et cetera. So I wanted to ask you the extent to which you agree with that. Now, it sounds like just in that last answer, you're saying, well, the kind of investment we've seen fueled by ultra cheap capital recently hasn't been laying fiber optic cable underneath the oceans. It's been more, kind of, I don't know, focused on rent seeking or consumption. And therefore, there isn't that tangible capital base that we're left over with after the bubble that might benefit us.
Yeah, I mean, I have thought about this question over the years. British had, in Devil Take the Hindmost, I talk about the British railway mania of the 1840s, when the huge amount of new rail track was authorized. And it seems that the result of that was there were too many sort of poorly designed rail routes, sometimes competing, and it seemed to permanently lower the return on capital of the UK rail system. In the case of the dot-com fiber optics, if you remember, there was massive initial oversupply. I think it was sort of, they talked about sort of dark fiber being sort of 95% of the fiber optic cable was not being utilized. In that, the slack got picked up a few years later, as far as I understand. But really, insofar there is a benefit, there is a sort of transfer of wealth from the investor to the consumer. The consumer, I mean, ideally, let's say in a sort of balanced economy, the investor should be doing something that is useful, investing in a business that provides some utility to consumers, and that both parties should get something from it, and the consumer should pay enough to deliver a positive return on capital for the investor. So when one, in the case of all those telecoms companies in Britain, they were called altnets and so on. When they went down to zero, it's probably not an efficient allocation of capital for society as a whole, even if the consumers end up with some benefit. Does that? I think that's a sort of more judicious view than the sort of, hey, bubbles are fun and afterwards we get all this great stuff.
Okay. No, I just remember reading that, and I always like when someone's presenting the flip side of an argument, and I don't think I'm a good enough economist or historian to really have a firm answer, but I could see that, particularly because I lived through the telecoms bust, lost a little bit of money on a few telecom companies that are no longer around, but then we're here having this conversation that's being facilitated by technology investment. So yeah, I'm not really sure how I come down on that one. I wanted,
Kevin, let me stop. I'll stop you. So
yes.
I'll go back, give you another case in the railway mania, Britain, which is quite interesting. Is that the leading figure of the British railway mania was a guy called Hudson out of York, and they operated on up in York on a narrow track railway, and as he took over all the other railways, they moved everything to the narrow track. But the narrow track actually turns out to be very inefficient. So it was as if during the sort of takeover mania that accompanied the railway boom, we were actually put onto the wrong railway system, which, if you ever take a train in England, you're sort of huddled together in a narrow carriage, and I dare say, the trains don't carry as much freight and so on. So that was a case where not only am I saying you get the wrong, too much capital invested, but you also actually end up with a sort of suboptimal rail system, railway technology. So there is a case there is a case for investing rationally. And if you invest rationally,
crazy as that sounds,
you're likely to satisfy all parties, I think.
Let's talk about just one or two more examples, kind of subtle examples of, again, kind of trying to keep on this theme of how the unintended longer-term consequences of low interest rates. And one that I hadn't really thought about, made a lot of sense once you explained it, was a kind of I think you might call it a globalization bubble, how low interest rates facilitated the existence of quite complex global supply chains, and that kind of in the short term is good in the sense that you basically can get things produced at where labor is the cheapest, which reinforces the low inflation, which keeps interest rates low, et cetera. But it also creates this sort of fragility, which obviously we're experiencing now. And means that potentially when interest rates are higher, then those maintaining those supply chains are not so easy. Could you explain that?
Yeah, I can try. So the relationship between interest and what we call globalization is interesting, and the first phase of globalization, second half, deemed to be sort of second half of the 19th century up to just before the First World War, was associated with declining interest rates, or very long. There was basically, I'm talking roughly, from 1850 to 1900 in the US and the UK, a very long bull market in bonds of falling long-term rates, and at the same time, this was a period of sort of rampant globalization, and there does seem to be a link between them, in that the more we trade with the rest of the world and access cheap labor in the rest of the world, the more the cheaper, there will be a sort of disinflationary or deflationary impact on the cost of traded goods, and there will be a dampening of the bargaining power of the domestic labor force. And that combination of weak bargaining power and falling traded goods prices induces a decline in the interest rate. So there is that's a 19th century example. And then you go back to a more recent period where global trade is largely financed in dollars. And these global supply chains are, in fact, they're funded, they're dollar funded by the sort of, the dollar being the global reserve currency. And so as the interest rates fell, as you had globalization, let's say, as you had a move towards globalization, that had a dampening effect on domestic wage growth and domestic and inflation and interest rates. But that brings down the dollar, the cost of dollar funding. Hey, it's much cheaper so let's expand our supply chain a tiny bit further. And think of it this way, it goes back to, I was mentioning earlier, the roundabout production methods, the amount of tying up capital in a very long supply chain. Well, if the cost of funding that supply chain is very low, you're going to have a very long supply chain. But the longer you create the supply chain, the more potentially fragile it is to say, for instance, a rise in interest rates, but also to other fragilities of the type we've seen more recently, with the sort of COVID supply, COVID pandemic supply shocks. But then there's the other element, which is that you have the political backlash against it. Suddenly, the workers who haven't had a decent pay rise for a decade or two suddenly think, hey, hang on a sec, why are they outsourcing all my jobs to the far end of the world? And hey presto, you get a man with ginger hair saying he's going to get to solve all your problems. So, but you see, you have to, the point is, one can try and analyze where the sort of source of the discontent comes from. And to some extent that as I said, the linkage between globalization, low interest rates, and then the feedback into political discontent seems to be, it's not provable, but it seems that you can observe something along those lines.
Yeah, it's funny because that's why I think economics is such a fascinating subject to study, because you push in one area and something else happens, and it's a dynamic, it's a social science. It literally evolves with the society. And one does feel, central bankers have been criticized a lot in your book and our book just generally, but one does, they have a hard task, and you can see why they would say, well, I'm just going to focus on inflation because all this other stuff is too complicated. And we had Andrew Smithers on the show, the last show, and Andrew's new book is about, I think his hope is that eventually central bankers could get to the point where they could say, hey, I can't lower interest rates anymore because if I do, I'm going to push other relationships out of whack. Now, Andrew is talking about one particular relationship, which I know you're aware of, it's just the Q ratio. But more broadly speaking, what we're saying is that, a narrow focus on interest rates risks destabilizing other areas that oftentimes we don't even, know until further down the road that we've destabilized. I think this globalization example is an excellent one in that sense of it. It takes a bit of thought and almost ex post observation to realize, oh, we've created another kind of aspect of fragility here.
Yeah, so one way of thinking of it is that the very low interest rates are like sort of fertilizer and they over-fertilize the environment and lead to sort of, in a way, weak and fragile ecosystem. I discuss in the chapter on creative destruction a metaphor that's quite commonly used of preventing how the central bankers, when they prevent the process of creative destruction, they're a bit like the US Forest Service that prevents forest fires, and in the end you get build-up of understory and so forth, and until eventually you get more fires and more severe fires as a consequence, and a less healthy forest. The question of what central bankers should be doing is a sort of deep and complex one. Jim Grant refers to the interest rate as the universal price, the most important price in the capitalist system. And I really think it is an issue that we have to sort of think about if we are embracing if we think we're living in a market economy and think that that is the type of economy that we want to live in, that do we want any body of people determining what the universal price is that affects everything else in the system? And if so, if we do want a committee of people making that decision, how are they to be judged, and what inputs are they going to have? And I think I've long been of the view that the inflation mandate, the idea of just, and particularly as inflation mandate then became a sort of narrow, specific target, was flawed, and that the early criticisms of what was used to be called price stabilization as the aim of central banking, which was that early criticism was put forward by Friedrich Hayek, who was a young economist working actually at NYU, I think on his PhD in the 1920s, at the time when the Federal Reserve under Ben Strong had adopted a policy of price stabilization, was supported by really all the leading economists of the day. Keynes, Rafe Hawtrey was a sort of distinguished economist at the UK Treasury, Gustav Cassel, and the greatest American economist of the 20th century, Irving Fisher. So, the great and the good were in favor of price stability, and the experiment with price stability ended, in 1929-30 with, a great crash and depression and severe price instability. And that lesson doesn't seem to have been learned. And you mentioned earlier that that Ben Bernanke is a historian of the Great Depression. Well, I don't want to be too harsh on Bernanke, but he has a sort of very narrow, rather dogmatic interpretation of what occurred in the 1920s, which is pretty much borrowed from Milton Friedman and Anna Schwartz's Monetary History of the United States, and in particular the famous chapter they wrote, which was then sort of published as a standalone book called The Great Contraction, with the idea that there was nothing wrong in the 1920s. Everything was going hunky-dory until the Fed tightened a tiny bit too much in 28, 29, allowed the stock market to collapse, and then allowed the money supply to collapse. So the Bernanke reading of history ignores, and even leaving aside Bernanke, so I don't know if you read it, the Alan Meltzer written a sort of hefty 2 or 3 volume history of the Federal Reserve, and they all leave out the sort of the Hayekian criticism of the price stability policy of the 1920s, which was a sort of critique delivered in real time rather than an ex post one. And see, as I mentioned in the book, it's sort of we like to think that that history is written by the victors, and you could have said that sort of Hayek analytically was a sort of victor of that period, but he just sort of didn't win the arguments in the 1930s. So he's been sort of airbrushed out of the histories, even though he won a Nobel Prize sort of 45 years later.
Yeah, it's funny you mentioned how deeply embedded the Friedman kind of view of the Great Depression was. I mean, the first business class I ever took, I think it was in high school, that was taught by a high school business teacher in Harrisburg, Pennsylvania, who was believed in Milton Friedman. And I came home with a copy of Capitalism and Freedom at the age of 16 and told my dad this is what I was learning in the business class. And he's like, I thought you were going to learn how to, what a balance sheet was, not what was going on with the money supply in the Great Depression. You talk about Benjamin Strong, who was the president of the New York Fed in the 1920s, and there's a quote from him where he basically, in 1927, is saying, "Hey, look," because I guess they were getting a lot of criticism for stoking a stock market bubble, and he says, "It's not really our business what's going on with the stock market. There's nothing we can do about that. And even if we were worried about it, we tried to sort of prick the bubble, it would have collateral effects, and that we couldn't control that." And it really echoed the way the Fed, I think, saw the world post the 2008 crisis. So it's a kind of another example of not really pulling the full lessons from history. But
Kevin, hang on a second. We can go back earlier. The same view was held in the late 90s during the dot-com bubble. And in fact, that was the time.
That was the Alan Greenspan "we'll clean up afterwards" view.
Exactly, and that was actually Bernanke wrote a paper, which I think was sort of 98, 99, on that. With someone called Mark Gertler, which was don't deal with the aftermath of bubbles. Don't try and lean into the wind or whatever they call it, and. I have this sort of, my guess is that's sort of why Bernanke was brought into the Fed, to sort of buttress the de facto, given a sort of, if you will, an ideological gloss on the de facto position of the Fed. And then, having done it then, let the dot-com bubble go to its extremes. They then, tried to clear it up, and they sort of got into a mess again, and then they did it a third time. It reminds me of, there is a nursery rhyme that English school children used to learn, which was I don't know if the Americans know, there was an old lady who swallowed a fly. Do you know that? So there was an old lady who swallowed a fly. I don't know why she swallowed a fly. And then it goes on, she swallowed a spider to catch the fly. Right. And then she swallows a bird to catch the spider, to catch it. And eventually she swallows a horse, and it goes, it ends with, she's dead, of course. So you just sort of follow, you sort of build up a bigger problem to solve the problem that you were dealing with in the previously. And I think that, I've been at that, I've been of that view, sort of nursery rhyme view, for almost 20 years, and actually it's sort of, if I felt I had grounds to change it, I would have done, but it does seem we sort of build up, the Fed policy of sort of trying to clear up afterwards, and then not really being cognizant of the unintended consequences of the clear up, gets you into a what one might call a sort of deeper state of disequilibrium than you would have been otherwise.
Yeah, and that's kind of the major theme that runs through The Rise of Carry, is this kind of ratchet effect where each intervention encourages carry trades to grow, encourages fragility debt to grow, and then the next intervention has to be bigger and bigger. I guess a little disturbing that 2 or 3 years of work could be summarized in a nursery rhyme, but there you go. So I think we've got to kind of wrap it up. And you had a quote in the book along the lines of, capital is the discounted value of future interests or for future income. So capital is discounted value, future income. And to do that calculation, we need interest. And if interest rates are at zero, then there's no capital. And if there's no capital, there's, there's no capitalism. So is it that serious in your mind? Is this policy of zero interest rates? And I know we've moved away from it, at least temporarily, but was it a genuine threat to capitalism in your view? Is that how you saw it or see it?
Yeah, I mean, I don't suppose I would have written that if I if I'd been insincere about it. No, I had this last sort of concluding chapter where I call it the new road to serfdom, because it draws on Hayek's book, The Road to Serfdom, written in I think 1943. And Hayek there is just talking about sort of wartime controls, and he has this sort of fear that these wartime controls, once in place, will never be removed, and one thing will lead to another, and we'll sort of all end up in a sort of quasi socialist state. But Hayek, as we've been talking about earlier, also had these sort of views about, probably of all the economists, he had the sort of deeper, all the great economists, he had the sort of deepest views, both about interest, but also how, how knowledge and information is decentralized in a society, which is why one needs the market system to sort of to market prices in order to coordinate activity. And in the last chapter, I tried to point out that if you have interest rates going lower and lower, and the system malfunctioning both due to low productivity, low investment, low savings, and the financial fragility that you've written about, then you require greater and greater state intervention to offset this. And this is sort of really what we've seen with the central banks, not just not just taking interest rates to zero or negative in some places, and not just buying government bonds, but then sort of intervening in the credit markets, and then more recently getting into sort of feeling they had to have a say about green investment or decarbonization. So it was a sort of creeping advance of what you might call sort of central bank capitalism, and perhaps I think that I suppose the whole magic modern monetary theory sort of has been put at the side for the moment. But if you want a capitalist system to work, it's one in which it has to deliver, as Hayek says, it has to deliver productivity growth and economic growth and it has to be a system in which ordinary people who don't have great advantages in their life to begin with can accumulate capital, buy houses, and save for retirement. So people have to have a sort of a stake in the society. And the zero interest rates, by making retirement savings difficult, almost impossible, or as actually as Jamie, my assistant, your co-author, says, that the low interest rates made the price of security more expensive. It pushed the security, whether it was your retirement security, whether it was your house, whether it was the cost of your education. So security becomes more expensive and out of reach for many people. And then the people, once that happens, fewer and fewer people support the system, and then the system is likely to atrophy. So it's sort of corroded from within, I would say.
Well, I very much appreciate that summary, and I would say what I've tried to do is direct the conversation to some of the unintended consequences that we might not all have thought about of low interest rates, and people may or may not agree with it. I'd say pick up the book, read them, think it through, and make up your own mind. The book is called The Price of Time, and thank you for your time, Edward. We really appreciate it, and we wish you all the best.
Thanks, Kevin. Nice to speak to you.
Okay, with that, I'll pass it back over to Niels.
Thank you very much, Kevin and Edward, for a very insightful conversation on the topic of the price of time and money. Edward is really a wealth of fascinating historical references and has a wonderful way of putting them into a narrative that is easily accessible. And as we learned today, he can even put central bank policies into old nursery rhymes. I must say that his view that zero interest rate policies really is a threat to capitalism was very interesting, as well as how he ties together the unintended consequences of low interest rates with globalization and the fragility that we see today in the global supply chains. Make sure you go and follow Edward's and Kevin's work, as well as getting a copy of their books, because as you can tell from today's conversation, some of these ideas and topics are not being discussed enough on mainstream media. From Kevin and me, thanks so much for listening, and we look forward to being back with you on the next episode. And in the meantime, take care of yourself and take care of each other.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.